Please like, share, and subscribe. Wishing you happiness and good luck every day.
Okay, let's dive into this. We're going to unpack a financial blueprint that has repeated itself over and over again for centuries. It's a pattern that the legendary investor Ray Dalio has basically dedicated his life to mapping out, and he calls it the Big Debt Crisis. So here's Dalio's big idea. He argues that these huge financial crises, they aren't just random black swan events that come out of nowhere. No, he sees them as predictable cycles, kind of like a recurring illness in the economy. And if you know the symptoms, well, you can see it coming. Another one of what? Well, another big debt crisis. So in this explainer, we're going to walk you through Dalio's template step by step. We're going to look at the anatomy of these massive economic events, from the crazy euphoric boom all the way down to the really painful bust. Now, to get our heads around something as massive and complicated as a national economy, it really helps to start small. And what's more familiar than a simple board game, right? You know, the entire economic engine really just runs on this one simple concept: credit. It's basically the power to borrow from your future self so you can spend more than you have today. And that promise you make to pay it back, well, that's what we call debt. And that simple act of borrowing, it kicks off this mechanical, totally predictable chain of events. See, if you spend more now, you have to spend less later while you're paying it back. This dynamic is true for you, and it's true for an entire country. That's the billion-dollar question, isn't it? How does this super simple cycle of borrowing and paying back suddenly blow up into a massive global crisis? Well, the answer is all about what happens when you add banks, lending, and a whole lot of human psychology into the mix. And this brings us to Dalio's absolutely brilliant analogy. Just think about a classic game of Monopoly. In the early game, cash is flying around, everyone's buying a property. But now, imagine you could get loans from the bank to build hotels. All of a sudden, the amount of debt in the game would just explode, way beyond the actual cash on the board. And eventually, players can't pay the rent, they default on their loans, and the whole system just crashes. That right there, in a nutshell, is how our economy works. So that Monopoly game, it brings us perfectly to the first huge phase of the real-world cycle, the bubble. This is the part of the story where that borrowing goes into total overdrive, and this powerful, self-reinforcing upward swing just takes off. So check this out. This is basically Dalio's roadmap for a debt crisis. It's a whole journey with these predictable stages, from the healthy early growth through the bubble and then on to the painful correction. For now, we're zeroing in on stage 2, the bubble. This right here is the key feedback loop. Think about it like this. Rising home prices mean you have more collateral, right? So the bank lets you borrow more money. You take that money, you buy another property, and that helps push prices even higher, and the cycle just keeps feeding on itself. And you can literally see that feedback loop in action right here. This chart averages dozens of historical crises, and it shows that steep, steady climb in asset prices. When you're in the middle of a bubble, it feels like the good times are never, ever going to end. But, and this is a huge but, there's a really dangerous secret hiding underneath that soaring market. Look at the blue line. That's the total debt. It's climbing way, way faster than the red line, which is the income available to actually pay for that debt. That gap between what's owed and what's earned, it's getting wider and wider. So, you get it, right? It's not just the amount of debt that's the problem. The really crucial point is the speed at which new debt is being created. The whole system is basically accelerating towards a cliff, and it's all fueled by this belief that the boom can just go on forever. And all that acceleration, it inevitably leads to the peak of the cycle. Because, as we all know, no party lasts forever. The music has to stop sometime. And man, Dalio just nails the psychology of this moment. It's a total paradox. The moment of maximum optimism, when literally everyone is convinced things can only get better, that is precisely the moment of maximum risk. The whole system is stretched to its absolute limit. So what's the pin that pricks the bubble? Well, historically, the trigger is almost always the same thing. The economy starts to overheat, maybe inflation picks up, and the central bank has to step in. They raise interest rates to cool things down, which basically takes away the cheap money that was fueling the party in the first place. And you can see that exact moment right here on the chart. That steep climb from the bubble phase just flattens out. The upward momentum is gone. The market has hit its peak and is basically teetering on the edge, ready to reverse. Now, what comes after this peak isn't just your garden variety downturn. When a debt bubble this huge finally bursts, it triggers something much, much more severe, the depression phase. Okay, and it's absolutely critical to understand the difference between a recession and a depression. In a normal recession, the central bank can cut interest rates to get the economy going again. But in a depression, that tool is broken. Interest rates have already been slashed all the way to zero, and they don't have any effect. The central bank is completely out of ammo.
And listen, this isn't some abstract theory. This chart shows this exact moment happening twice in modern U.S. history. In the 1930s and again in 2008, interest rates just slammed right into that zero floor. And at that point, the number one tool for fighting the crisis became totally useless.
And the result is a violent reversal. That self-reinforcing cycle that created the bubble, it now works in reverse. Falling asset prices means credit dries up, which leads to lower incomes, which forces more asset sales, and the downward spiral just keeps feeding on itself. This is the painful process we call deleveraging. But the story doesn't have to end in a complete economic collapse. I mean, while it's painful, the fallout can be managed if the people in charge understand which levers they need to pull. Dalio identifies 4 main tools to manage the crisis. Policymakers have to find a way to balance austerity, cutting spending, with letting some debts just get written off. At the same time, they need to print money to keep things flowing while also transferring wealth to help those who got hit the hardest. Getting this delicate mix just right is the key to what Dalio calls a beautiful deleveraging. It's a way to get the debt down without completely destroying the economy. So, the template is there. It's as clear as day, repeated all throughout history. Understanding this cycle, it really changes how you see the economy. It transforms what looks like just random chaos into a predictable, mechanical, and deeply human pattern. The only question that's left is, will we be smart enough to recognize the pattern next time it happens?
Let's talk about debt. I know, it's a word that can make us all feel a little tense. But what if I told you that debt is one of the most powerful forces out there, shaping our entire economic world? Today, we're going to dive in and really understand this predictable and pretty wild cycle of boom and bust that debt creates. So right off the bat, let's tackle the big question we all have. Is debt just bad? I mean, that's what most of us are taught, right? Avoid it at all costs. But the real answer, well, it's a lot more complicated and honestly, way more interesting than a simple yes or no. See, it all comes down to how the debt is used. You've got productive debt. Think of a loan for a factory that's going to churn out products and generate income to pay for itself. And then you have unproductive debt, maybe financing a lavish vacation. Fun, for sure, but it doesn't create any income. You just have to pay it back. And that distinction, it's everything.
And that whole idea of paying it back, that right there is the absolute heart of what a debt cycle is. It's a concept that's actually, when you boil it down, incredibly personal.
Here's the best way to think about it. When you take on debt, you're not just borrowing from a bank. No, you are literally borrowing from your future self. You're guaranteeing that at some point down the road, you're going to have to spend less than you earn to make things right.
So every debt cycle, big or small, has 2 basic phases. First, you get the upcycle, where you get to spend more than you make. That feels great, but it's always, and I mean always, followed by the down cycle, where you have to spend less than you make to pay it all back. And this simple little pattern, it applies to you with your credit card just as much as it applies to the entire US economy. Okay, so to really see how this plays out on a giant scale, we need a good analogy, something that makes this whole complex idea just click. So let's think about the economy like a game that I'm pretty sure we've all played.
Yep, Monopoly. Believe it or not, the mechanics of this board game are a fantastic little model for how credit and debt actually work in the real world. Let's start with a normal game. No funny business. So in a standard game, there's this natural ebb and flow, right? Early on, everyone's flush with cash, and the goal is simple. Buy, buy, buy. Convert that cash into assets. Property is king. But fast forward to the late game, now there are hotels on Boardwalk. You're terrified of landing there. All you want is a giant pile of cash to survive. All of a sudden, cash is king.
Okay, now let's change the rules. Let's introduce some chaos. What happens if the bank in the middle of the board doesn't just hand out money when you pass go, but can actually start making loans?
Whoa, suddenly you can borrow to snap up Park Place way ahead of schedule. There's a massive building boom. It's incredible. But pretty soon the problem becomes painfully obvious. Nobody has enough cash to pay rent and make their loan payments. The whole system gets squeezed. Players start going bankrupt. Even the bank might go broke. The game's economy just grinds to a halt. It's a perfect, miniature boom and bust cycle.
Now, when a game of Monopoly crashes, you just get mad and put the board away. But when this same thing happens to an entire country, the stakes are, well, astronomically higher. So what does this actually cost in the real world? Just how bad can it get?
Let's use a real-world example. Imagine a government borrows $1 billion to build a shiny new subway system. The plan is that ticket sales will eventually pay back that loan. Sounds like classic productive debt, right? What could go wrong?
Well, what if the revenue is only half of what they projected? Now the debt has to be written down by 50%. That sounds like a total disaster. But is it? Here's the real question. Is having a subway, even if it effectively costs more than you thought, still better than having no subway at all? A lot of the time, the answer is, yeah, it is.
Okay, so let's scale that up from one subway to a whole country. When a major debt crisis hits, the total loss from all that bad debt can equal around 16% of a country's entire gross domestic product. That is not just a number. That is a jaw-dropping, economy-shattering catastrophe if you had to take that hit all at once.
But what if you didn't have to take it all at once? What if you could take that huge 16% blow and just spread it out over, say, 15 years? Well, now the cost is more like 1% of GDP per year. Now, don't get me wrong, that's still painful, but it's manageable, it's tolerable, and that is the entire game for policymakers, spreading the pain out to make it survivable.
So how on earth do they do that? What kind of tools are in their toolkit to take an absolute economic disaster and wrestle it into something manageable? It turns out they've got 4 main levers they can pull.
Okay, so you've got austerity. That just means everybody spends less. You can allow defaults and restructure the debt. The central bank can step in and, print money. And finally, you can transfer wealth from those who have it to those who need it. Now, some of these, like austerity, are deflationary. They slow things down. Others, like printing money, are inflationary. And you better believe every single one of them comes with a huge political price tag.
And this brings us to this amazing phrase from the source material. The goal of policymakers is to create a beautiful deleveraging. And what that means is they have to skillfully blend all 4 of those levers, the deflationary and the inflationary ones, to bring the debt down without totally crushing the economy. It is an incredibly delicate balancing act.
And this, right here, is probably the most important takeaway from our whole discussion. The debt itself, that's not usually what causes the ultimate catastrophe. The real danger, the biggest risk, comes from a failure of policymakers to do the right things at the right time. These crises are almost always manageable if you have people in charge with the knowledge and the authority to act.
As we've walked through all of this, it's clear that the logic of these cycles is almost mechanical. It's a predictable series of events driven by human nature. And that brings up one final, really fascinating question. If this pattern of borrowing from our future, this cycle of boom and bust, is so logical and it has happened over and over and over again throughout history, then why does every single crisis seem to catch us completely by surprise? It seems that sometimes the simple logic of economics is just no match for the complicated psychology of being human. And that is definitely something worth thinking about.
The Great Depression, the 2008 financial crisis. You know the names, right? These aren't just bumps in the road. They're events that literally change the course of history. But what if they're not just random bolts from the blue?
And that's the big question we're tackling today. Are these massive economic meltdowns completely random, like a roll of the dice? Or is there something else going on, a kind of predictable pattern, a template they all seem to follow? Well, it turns out when you look at the data, specifically an analysis of 48 of these major crises, you find something pretty incredible. A surprisingly consistent pattern emerges. So, yeah, it really looks like there is a template. Okay, so here's our game plan. We'll start with what this template for a crisis actually is. Then we'll dig into the debt engine that powers the whole thing and what happens when it goes into overdrive. We'll look at 100 years of data to see this pattern in the real world, and importantly, what that data doesn't show us. And we'll wrap up by asking the million-dollar question, what does this all mean for today? All right.
Section 1. A template for crisis. So, how do we even define what a major economic crisis is? Before we can find a pattern, we need to agree on what we're looking for. The analysis is really specific here, which is great. We're not just talking about any old recession. The definition for a depression is when a large country's real GDP, its actual economic output, falls by more than 3%. That might not sound like a huge number, but trust me, in economic terms, that is a very, very high bar.
Okay, moving on to part 2, the debt engine. So what actually gets this cycle started in the first place? Well, it all comes down to one thing.
The whole thing starts with this really basic imbalance. The cycle really kicks into high gear when the amount of debt people have, plus the interest they have to pay on it, starts growing way faster than the incomes they have to pay it all back. It's like your bills are growing faster than your paycheck, but on a massive national scale. Now, this doesn't happen overnight. You know, the normal short-term business cycles, right? The little booms and busts? Well, imagine those stacking on top of each other, over and over for decades. With every single cycle, the overall debt level gets a little bit higher at the peak, and it doesn't fall as far in the trough. It's like a tide that's slowly, almost invisibly, rising over a very long time. All right, Section 3, reaching the limit. So why can't this expansion just last forever? Obviously, a cycle of ever-rising debt has to end somewhere. So what's the breaking point? Why does the music finally stop? This is where we see the huge difference between a normal downturn and one of these super crises. In a typical debt crisis, what do central banks do? They lower interest rates, right? That makes it cheaper to borrow, and it helps get things moving again. But in a severe debt crisis, the kind that leads to a depression, they can't do that. Why? Because interest rates have already hit zero. They've used that tool over and over, and now there's nothing left in the toolkit.
So let's just walk through that sequence step by step. First, debt starts to outpace income. So to keep the party going, the central bank steps in and lowers interest rates. Now this is a clever trick because it keeps the monthly payments on the debt from feeling too painful, but the total amount of debt keeps climbing and climbing. Step 4, interest rates finally hit zero. And that's the wall. There's nowhere left to go. And that's when step 5 kicks in, the deleveraging, the painful process of actually dealing with all that debt.
Okay, part 4, a century of debt. So that's the template in theory. But what does this look like in the real world? Does the data actually back this up? Let's find out. And here you have it. This one chart basically tells the whole story. What you're looking at is the total U.S. debt burden as a percentage of GDP, going all the way back to 1910. Okay, so follow the red line with me. That's the total amount of debt. See how it just keeps climbing over the decades? Now look at the green line. That's the debt service, basically the cost of carrying all that debt. For long, long stretches, the Fed was able to keep that green line pretty flat by constantly lowering interest rates. That's what allowed the red line, the total debt, to keep soaring higher and higher. But it can't last forever. And you can see exactly where the system hits its limit. Look at those two massive peaks in the red line. One is right around the Great Depression in the 1930s, and the other is right around the 2008 financial crisis. That's the template right there on the screen.
And just to put a number on that second peak, around 2008, total U.S. debt hit almost 380% of GDP. Think about that for a second. The country's total debt was nearly 4 times the size of its entire annual economic output. It's just a mind-boggling number, and it was the culmination of a cycle that had been building for decades.
Okay, on to our next section, the unseen liabilities. Now, that chart is incredibly powerful, but what does it not tell us? Because no single chart can capture the whole picture, and it's really important to know what's being left out.
So the analysis points out 2 major things. First, this chart is inadequate because it just lumps all the debt into one big pile. It doesn't show you the differences between government debt, corporate debt, and household debt, which are all very different animals. And second, and this one is huge, it only includes things that are officially labeled as debt. It completely leaves out other massive liabilities, things like promises for future pension payouts and healthcare obligations, which are, enormous. So, Section 6. What happens next? Let's try and put this all into perspective. We've looked at the template, we've seen the data, we've talked about what the data misses. So what's the big takeaway here?
This quote really says it all, doesn't it? Classically, a lot of short-term debt cycles add up to a long-term debt cycle until the interest rate reductions can no longer continue. I mean, that's the whole machine in a nutshell. You take all those small ups and downs, stack them up over decades, and it all works, as long as you can keep cutting interest rates. The whole thing comes to a head when that one crucial lever just doesn't work anymore. And that's really the power of understanding a template like this. It gives you a kind of map of how these massive crises have played out in the past. But of course, a map is only really useful if you know where you are on it. And that leaves us with the biggest, most important question there is. The template shows how past crises unfolded. The question is, where are we now?
All right, let's dive into a huge topic today, one that really shapes our economies for generations. It's called the long-term debt cycle. And look, this isn't about the regular recessions we hear about on the news. This is something much, much bigger, a massive pattern of boom and bust. Honestly, understanding this is pretty key to understanding the world we're living in right now.
And you know, this isn't some newfangled idea from Wall Street. The concept that huge piles of debt eventually need some kind of reset is ancient. I mean, it's right there in the Old Testament. It's a fundamental economic drama that has been playing out for literally centuries. So what exactly is this thing we're talking about? Well, the long-term debt cycle is this massive wave that builds up over 50 to 75 years. A good way to think about it is like this. The short-term business cycles we're all familiar with, those are like the waves you see on the ocean's surface. But this cycle, this is the powerful tide underneath, the thing that's really driving everything. Okay, so to really get a handle on this powerful tide, we're going to follow its entire story, from start to finish. We'll start by digging into its ancient roots, then we'll ride the high of the boom, brace for the impact of the bust, look at the different kinds of fallout that can happen, and finally, we'll see what it takes to get to the Great Reset on the other side.
So, where does a cycle that can last a lifetime even begin? Well, it all starts with something incredibly simple, and frankly, super predictable. It's just human nature.
See, at its very core, the whole thing is fueled by our collective human tendency to always want a little bit more. As a society, we just naturally lean towards borrowing and spending instead of saving and paying things down. And over decades, this slow, almost invisible tilt just keeps building, creating a mountain of debt inside the whole system. And that collective tendency, that's what kicks off the first, and let me tell you, the most exhilarating phase of the cycle, the boom. This is the part that feels absolutely fantastic, and it's all fueled by this really powerful, self-reinforcing logic. The engine of this whole boom can be boiled down to one simple, powerful idea. My spending is your income, right? When I take out a loan to buy something, that money goes to someone else. Their income goes up, which makes them feel richer, and guess what? It means they can go out and borrow and spend even more. And that right there is how the fire gets lit. This creates an incredibly powerful feedback loop. It all starts when credit gets easy and cheap. That fuels more spending, which, as we just said, raises incomes. Higher incomes then push up the value of assets, things like stocks and houses. And because those assets are now worth more, people can use them as collateral to borrow even more money. The whole system just feeds on itself, accelerating and accelerating into this massive economic expansion. And during this time, everyone feels like a genius. Lenders look at borrowers who seem incredibly prosperous, so they loosen their standards. Why not? Borrowers feel wealthy, so they take on more debt. Of course they do. But this widespread optimism hides a really dangerous reality. The entire system is becoming over-leveraged. It's just a fancy way of saying it's built on a foundation of debt that is growing way, way faster than the income needed to support it. But you know how it goes. A party like this can't last forever. Eventually, gravity has to kick in. And when this cycle finally turns, the reversal is every bit as powerful as the boom that came before it. So the crucial point is this. The party stops for a very simple reason. You just hit a point where the amount of debt in the system is too big compared to the income available to pay for it. The math simply stops working. That's it. And remember that self-reinforcing loop that created the boom? Well, it now goes into a vicious reverse. It starts when lenders and investors get scared and just stop. People then cut back their spending to save cash. But since my spending is your income, incomes just plummet across the economy. Suddenly, people can't pay their debts, asset prices collapse, and the whole system just spirals downward. And this, right here, reveals the critical difference between this kind of a bust and just a normal recession. Usually, a central bank can just cut interest rates to make borrowing cheaper and restart the economy. But at the peak of a long-term debt cycle, interest rates are often already at zero, or pretty close to it. The central bank has basically run out of ammunition. Their main tool is gone, and the system is effectively broken. So what happens next isn't always the same. It turns out the kind of depression an economy goes through depends on one crucial factor. who you owe the money to. So on one hand, if most of your country's debt is owed to its own citizens and it's in your own currency, you typically get what's called a deflationary depression. Here, the pain comes from falling asset prices and really tough budget cuts. The silver lining, if you can call it that, is that eventually the central bank can print more of its own money to help soften the blow. But if a country owes a lot of debt in a foreign currency, like, say, US dollars, it faces an inflationary depression. When the crisis hits, foreign money flees, the local currency collapses, and prices for everyday stuff just skyrocket. That country is totally trapped because it can't just print the US dollars it needs to pay back its loans. And all of this leads to the final and often the most painful act in this whole drama, the Great Reset, or, as economists call it, deleveraging. That oversized pile of debt, it simply has to be dealt with. So, deleveraging sounds like a complicated word, but it's just the painful but absolutely necessary process of bringing those debts back in line with incomes. It's a great rebalancing. The mountain of financial claims on the economy, all that debt, is just too big for the real economy to ever repay. So those claims have to be reduced one way or another. This painful rebalancing act forces three key groups into a conflict. You've got the workers, whose jobs and incomes are on the line. You've got the capitalists and investors who lent out their money and, understandably, want it paid back. And then you have the government, stuck right in the middle, forced to step in and try to manage the whole crisis.
And because this process is fundamentally about who has to take the losses, about restructuring debts and redistributing wealth, it is almost always politically explosive. It just sparks this bitter struggle between the creditors, you could call them the haves, and the debtors, the have-nots, over one huge question: who is going to pay for this crash?
So as you can see, this isn't just some random economic event. It's a template, a pattern that has repeated for centuries, all driven by the predictable rhythms of human nature. This cycle of boom, bust, and reset is one of the most powerful forces shaping our world. Which, of course, leaves us with one final and pretty crucial question. If we know this template exists, where are we in the cycle today? You know those huge financial crises, the ones like 1929 or 2008? They feel like they just come out of nowhere, right? Like these massive, random, catastrophic events. But what if they're not random at all? What if they're actually part of a predictable pattern, a cycle that's been repeating for centuries? Okay, let's dive into this. So what's really driving these massive booms and busts we see? Is it just a bit of bad luck or mass panic? Well, not exactly. The answer, as you're about to see, is all about the surprisingly simple but incredibly powerful mechanics of debt. And this right here, this is our roadmap for the whole thing. Think of this chart as the blueprint for an entire long-term debt cycle. We're going to walk through this journey together, phase by phase, from the exciting highs to the painful lows, and you'll see exactly how it all fits together. So every cycle starts in a really good place. This is the early, healthy phase, the foundation for real, sustainable growth. Now, debt is growing, sure, but it's the good kind of debt. It's being used for productive stuff, like a business building a new factory. And here's the key. Income is growing right alongside it, or maybe even faster. Everything's in a nice, healthy balance. But then, things start to change. It's a subtle shift at first, but we slowly drift into what's known as the bubble phase. And this is the danger zone. This is where debt starts to grow way faster than the income that's supposed to support it. And that's when this crazy, self-reinforcing upward spiral really kicks into high gear. Let's bring this down to a personal level so you can really feel it. Imagine you make, say, 50 grand a year, but you go out and borrow an extra 10 grand so you can spend 60. For a little while, you're going to feel richer, right? Of course. You're basically pulling your future spending into today. Now imagine an entire economy doing that. For a while, it feels absolutely incredible. And that incredible feeling, that's what inflates the bubble. But here's the thing you really have to understand. A bubble isn't just about prices being high. It's a process. It feeds on itself. When assets like stocks or houses go up in value, people feel wealthier. So what do? They borrow more against that new wealth to buy even more assets. And this is that feedback loop laid out perfectly. Just look. Step 1, asset prices go up. That makes your net worth and your collateral look great. So, step 3, the banks are happy to lend you more money. What do you do with that money? Step 4, you buy more assets, which, yep, you guessed it, pushes prices even higher. And the whole thing just goes round and round. And look, this isn't just some abstract theory. The data proves it. You can see it right here in the charts. During that highlighted bubble phase, look at how total debt and stock prices are just rocketing up together. They're literally feeding off each other all the way to the top. Okay, so how do you spot one of these things in the wild? Well, analysts have this handy checklist of 7 telltale signs. You've got things like crazy high prices compared to history, and that general feeling, that broad bullish sentiment, where everyone is convinced prices can only go up. Oh, and tons of new, inexperienced buyers jumping in. Does any of that sound familiar? Knowing these signs is so important because it helps you see the risk that's building up all around you. And again, this isn't just academic. Check out this table. It applies this very framework to the biggest bubbles in modern history. The US housing bubble in '07, the dot-com bubble in 2000, Japan in the late 80s, even the US back in 1929. Look at that. They all hit almost every single one of these markers. The pattern is just undeniable. It's incredibly consistent.
But of course, a party like this can't last forever. That self-reinforcing cycle eventually hits a ceiling. You reach the top. And that moment, it's a mix of peak optimism, peak borrowing, and peak danger. The music is about to stop.
The psychology at this point is fascinating. At the absolute peak, things are so good they literally cannot get any better. But what does everyone believe? That they're going to keep getting better. It's that huge gap between reality and what everyone expects. That's the classic sign of a market top. So what's the pin that pops the bubble? Well, more often than not, it's the central bank. The economy is running so hot that they get worried about inflation. So they step in and start to tighten policy. They raise interest rates, and that makes all that borrowing more expensive, and it starts to cut off the oxygen, the credit, that was fueling the whole party. And the effect is usually pretty quick. As interest rates start to climb, the stock market sputters and hits its peak. And that same self-reinforcing cycle that shot everything to the moon, it slams into reverse. Now it's a downward spiral, and the steep descent begins. This reversal sends us spiraling into the most painful part of the entire cycle, the depression. And we need to be clear, this is not just a normal recession. This is something much deeper. It's a massive, painful unwinding of all the debt and all the crazy excess that was built up during the bubble. So what's the big difference between a recession and a depression? It really boils down to one critical thing. In a typical recession, the central bank can always cut interest rates to give the economy a boost. But in a depression, interest rates are already on the floor. They're at or near zero. Their number one weapon is completely useless. And this is not a hypothetical scenario. Just look at this chart. See the 1930s? See 2008? In both of these massive crises, interest rates hit rock bottom. Zero. Policymakers literally ran out of ammo. They had nothing left in their traditional toolkit to fight the downturn. This quote just perfectly captures the shock of it all. Much of what they thought of as their wealth was merely people's promises to give them money. It's a terrifying realization, right? People wake up and understand that what they thought was money was actually just credit. It was just a promise. And when those promises start to break, that wealth doesn't just go to someone else. It evaporates. It just vanishes into thin air. So if their main tool is gone, what do policymakers do? How do you fix a mess this big? Well, it's not totally hopeless. They have to reach for a different set of tools, a whole new playbook to try and manage the crisis, and, fingers crossed, steer the economy toward a recovery. And they've basically got 4 big levers they can pull. First, austerity, cutting spending. That's always painful. Second, debt defaults and restructurings, which is also painful. Third, the controversial one, printing money to fill the hole left by all that vanishing credit. And fourth, transferring wealth from those who have it to those who don't. The real trick, the art of it, is not just pulling one of these levers, but finding the right balance between all 4. Now, the lever that gets all the attention is printing money. You've probably heard it called quantitative easing, or QE. And what it means basically is the central bank creates new money, poof, out of thin air, and uses it to buy up financial assets. It's a way to pump cash directly into the system when it's seizing up. And as you can see from this chart, this is not some radical new idea. They did it back in the Great Depression, and they did it in a huge way after 2008. And when policymakers get that delicate balancing act just right, you get something the source material calls a beautiful deleveraging. Now, why beautiful? Because it manages to chart a path right down the middle. There's just enough stimulus from the money printing to counteract the pain from the spending cuts and the defaults, but not so much that you get crazy inflation. It's the best case scenario, really. It's how you lower the country's debt burden without totally wrecking the economy in the process. And just like that, the cycle comes full circle. This whole pattern, the boom, the bust, the painful recovery, it's not new. It has played out over and over again for centuries in all sorts of different countries. The details change, but the basic mechanics, they're timeless. Which, of course, leaves us with the billion-dollar question. If you look at this roadmap we just walked through, where do you think we are right now?
All right. Today we're going to talk about something that sounds, well, completely impossible. A total economic contradiction, but it's also one of the most destructive things that can ever happen to a country. So, let me paint a picture for you. Just imagine an economy in a total nosedive. We're talking businesses shutting their doors, unemployment shooting through the roof, the whole financial system just grinding to a halt.
Okay, but here's the crazy part. While all of that is happening, the price of everything you need, your groceries, gas for your car, rent, it's not just going up, it's exploding. This, right here, is the terrifying paradox we call an inflationary depression.
So your first question is probably, how on earth is that even possible? Well, that's exactly what we're going to get into in our first section as we unpack this whole paradox.
So, what is it? The source material we're looking at calls it a really painful mix of a severe economic crash, a depression, and prices that are just out of control. But the real key, the thing that makes it all happen, is a currency that's basically collapsing. Okay, so what causes this? What makes people suddenly just give up on their own money? Let's dive into that in Section 2, which we're calling the Great Escape.
The engine behind this whole disaster is something the source calls the currency dynamic. And really, it's just a vicious cycle. Think of it like a snowball rolling downhill. Once it starts, it just gets bigger and faster, feeding on itself, pushing the currency's value down, down, down.
And to get why that spiral even begins, you gotta remember a really basic thing about money. It's supposed to be a storehold of wealth. Now, that's a fancy term, but all it means is you have to trust that the $100 in your wallet today will still be able to buy you stuff tomorrow. It's all about faith.
So, what happens when that faith breaks? Well, this slide lays out the logic perfectly. It's actually pretty simple. Imagine you're an investor, and you're holding, I don't know, a bunch of Argentinian pesos. Suddenly, you get scared that those pesos are going to be worthless soon. What's your next move? You sell. You dump the debt, you dump the currency, and you run to something you think is safer. Maybe US dollars, maybe gold. It becomes a total stampede for the exits.
Now, this massive rush of money leaving the country creates a nightmare scenario for the people who are supposed to be in charge. And that brings us right to our third section, a central banker's dilemma.
Seriously, think about it. You've got billions of dollars just flooding out of the country. If you're the central bank, what do? What tools do you even have left in your toolbox to stop this thing?
And this slide just shows you what a terrible trap they're in. It's an impossible choice, a real damned if you do, damned if you don't situation. Option A, you can jack up interest rates through the roof to try and convince people to bring their money back. But the side effect? You make borrowing so expensive that you absolutely crush your own economy. Okay, so what about option B? You can just print more money to try and get things going again. But that just makes the currency worth even less, basically pouring gasoline on the inflation fire.
And the source material really puts a fine point on it. The central bank is stuck. They can either tighten credit and wreck the economy, or they can print money and wreck the currency. There is just no good move here.
Now look, this kind of catastrophe doesn't just happen out of the blue, and it doesn't happen everywhere. There are specific conditions that make a country way more vulnerable. So let's look at the ingredients, the recipe for a crisis in Section 4. And this leads to a really important question, right? What are the warning signs? How can you spot a country that's teetering on the edge of one of these currency meltdowns?
Well, the source gives us this incredible checklist, kind of like a diagnostic tool. So here are the red flags. A country's in big trouble if, number one, it doesn't have one of those big trusted reserve currencies. Then you add in things like not enough foreign cash reserves to prop up their own currency, a ton of debt that they owe in other currencies, huge and growing government deficits, interest rates that are actually losing you money because they're lower than inflation, and of course, a history where people just don't trust the money. You can literally see a bunch of these ticking in places like Turkey or Argentina recently. It's the perfect storm.
And the key takeaway here is that these aren't just isolated problems. They all stack up. They feed off each other.
The more of these boxes a country checks, the higher the odds it's going to spiral into this kind of inflationary depression.
Okay, so it's really easy to hear all this and think, well, that's a problem for other countries, right? Developing nations, or stuff you read about in history books. But that brings us to the big final question. Could it happen here?
Now, to be clear, countries that have a major reserve currency, think the US dollar, are way less likely to have this happen to them suddenly. Why? Because the whole world kind of needs their currency to do business. But, and this is a huge but, that doesn't mean they're immune.
Yeah, the source makes this really interesting point. For the big, powerful economies, the process is totally different. It's not a sudden shock. Instead, it's more like a slow burn. As the quote here says, it happens way more slowly, usually at the end of a long cycle of other economic events. So what does that slow burn actually look like? Well, this slide walks us through it. It starts with a country just repeatedly printing money to get out of one jam after another. Over years, maybe even decades, this starts to wear away at the world's trust in that currency as a safe place to park their money. Then, investors slowly, quietly start moving their money elsewhere. And over time, that special reserve currency status starts to crack, and that creates the exact same kind of vulnerability we were just talking about.
And that leaves us with one final, pretty heavy question to think about. If just print more money becomes the go-to solution for every single economic problem we face, could that very solution be planting the seeds for a much, much bigger and more dangerous crisis later on? It's definitely something to chew on.
Have you ever watched a country's economy go from being this amazing success story to a complete disaster, and it feels like it happened overnight? Well, it's a story we see again and again in economics, a boom-to-bust cycle that's fueled by debt. But what if I told you this wasn't just random chaos? What if it's actually a recurring, predictable pattern that countries fall into, time and time again?
So that's really the big question we're going to dig into. Why does this keep happening? How can an economy that looks so strong on the outside be so fragile on the inside that it just shatters?
Well, here's the thing. These crises usually aren't chaotic accidents. They tend to follow a classic, repeating five-act play. And once you learn to spot the stages, you can actually see these things developing from a mile away.
All right, so here's our roadmap. First, we'll look at how the good times get started. Then we'll see how things get out of control and a bubble forms. After that, we'll pinpoint the exact moment it all reverses. Then comes the painful crash, and finally, we'll look at the long, difficult road back to recovery. Okay, so let's start at the very beginning. Every one of these stories starts with a healthy, promising economy. I want to be clear, this isn't a bubble yet. This is real, productive growth, built on a pretty solid foundation. Now, before we go any further, there's one key term we have to get our heads around: foreign exchange reserves. The easiest way to think about this is like a country's national savings account, but it's filled with hard currency, usually US dollars. It's the financial cushion a country builds up when times are good. And trust me, it becomes absolutely critical when things go bad. In these early days, everything is just clicking. You know, debt is low and manageable, the country has good fundamentals, so it's attracting foreign money that's being invested productively, exports are booming, which makes the local currency more valuable, and the central bank is taking all this foreign money coming in and using it to build up those crucial reserves we just talked about. It's a virtuous cycle. Everything's going right.
But, virtuous cycles can overheat. And that brings us to stage 2, where we see healthy growth start to morph into a really dangerous, debt-fueled bubble. Optimism turns into euphoria, and caution, well, that gets thrown right out the window.
Now check this out, because this chart shows the exact moment things start to shift. That initial productive borrowing gives way to a full-on debt binge. Just look at that line shooting upwards. That's total debt as a percentage of the entire economy. You can see it just accelerating. The party's getting started, and it's all being paid for with borrowed money from overseas.
And this illustrates the paradox of the bubbles so perfectly. The strong currency, which used to be a sign of health, now actually becomes a problem. As you can see, the currency's value just keeps rising during this bubble phase. This makes the country's exports way too expensive for the rest of the world, and at the same time, it makes foreign imports feel incredibly cheap at home. The country starts losing its competitive edge, but nobody seems to notice because everyone's having too much fun.
And here's a number that really puts that into perspective. On average, foreign debt swells to equal 45% of the entire country's annual economic output. Just think about that for a second. Nearly half the economy is being propped up by foreign loans. The country is now incredibly vulnerable.
The foundation has gotten really, really fragile. And that brings us to the third and, honestly, the most dramatic act, the tipping point. This is that heart-stopping moment when the self-reinforcing boom slams into reverse and becomes a terrifying, self-reinforcing bust. The mood shifts from euphoria to just fear in an instant.
Look at this chart, right here. This is the moment the music stops. That flood of foreign money that was fueling the party, it doesn't just slow down, it stops, and then it rushes for the exit. Economists call this a sudden stop, and it is the trigger for the entire crisis. The economy was basically addicted to this foreign money, and its supply just got completely cut off.
So what happens? The central bank panics. To try and stop the money from leaving and prevent the currency from totally collapsing, they do the only thing they really can. They jack up interest rates to insane levels. You can see it right here. Rates just skyrocket. They're trying to bribe investors to stay, but this move also strangles the domestic economy, which is already starting to get weaker.
And right around this time, you will almost always hear this. Just before the collapse, officials will go on TV and make these grand, confident pronouncements. It's a mix of desperation and just political necessity. They have to project confidence. But it's become a classic, almost tragic part of the script that so often comes right before the fall.
Because those defenses, they almost never work. Now we enter stage 4, the depression. The currency defense fails, the dam breaks, and the economy is just swept away in the flood.
This slide shows the brutal 1-2 punch of the crisis. On the left, you see the currency value just falling off a cliff, a collapse of around 30% on average. Now look to the right, and you see the direct result. As the currency crashes, everything the country imports, from fuel to food, suddenly costs a fortune. And this causes inflation to explode, just crushing the purchasing power of ordinary people.
And remember that massive pile of foreign debt we talked about? This is where it becomes an absolute nightmare. For every company, every family, every person that borrowed in dollars, the amount they owe in their own local currency just exploded. That 45% of GDP we saw earlier, it suddenly becomes 60 or 70%, not because they borrowed more, but because their own currency is now worth so much less. It's a debt trap, and there's no easy way out.
The inevitable result is a deep, painful recession. This chart shows what economists call the GDP gap. Basically, it's the difference between what an economy could be producing and what it actually is. You can see it just plummet. Businesses fail, investment dries up, and unemployment soars. This, right here, is the very real human cost of the bubble bursting.
But even the worst storms eventually pass. And this brings us to our final act, the road to recovery. It's a painful process, for sure, but the very forces that cause the collapse also contain the seeds of a turnaround. Hitting bottom forces a painful but absolutely necessary reset.
But here's the twist. That currency collapse is a double-edged sword. Yes, the devaluation causes immense pain for savers and anyone with foreign debt, but that same weak currency is also the beginning of the cure. Suddenly, the country's exports are incredibly cheap and attractive to the rest of the world. It also forces people to buy fewer expensive imports, and for brave investors, the country's assets are now on sale at a massive discount.
And how a country navigates this moment makes all the difference. As you can see, the playbook for a well-managed crisis involves a quick, large devaluation, sort of like ripping off a Band-Aid, to get the pain over with and restore stability. A poorly managed crisis, on the other hand, involves a slow bleed of small devaluations that just prolong the uncertainty. Good policy uses those precious reserves to smooth the fall. Bad policy wastes them trying to prevent the inevitable.
So there you have it, the 5 stages of the inflationary debt cycle. This isn't some new phenomenon. It's a story that has played out across centuries and continents. The real question is, now that you know the warning signs, the rapid debt growth, the overvalued currency, the reliance on foreign capital, take a look at the headlines. Which economies today do you think are showing the telltale signs of building the next bubble?
Have you ever really thought about what happens when money just stops working? When the cash in your wallet is basically worthless paper? Well, today we're going to dive into one of the most terrifying things that can happen to an economy, the hyperinflation spiral. It sounds like something out of a disaster movie, but as you'll see, it's a spiral with very clear, very understandable steps that just keep feeding on themselves.
So, first things first, let's get our heads around just how extreme this is. We are not talking about the kind of inflation you hear about on the news, prices going up a few percent. No. Hyperinflation is when prices can more than double every single year. Sometimes it's even faster than that. This isn't just some economic headache, it's an absolute catastrophe that completely wipes out people's savings and causes just unbelievable hardship.
So the big question is, how on earth does a country get to this point? It definitely doesn't happen overnight. It all starts with a single, critical choice.
At its very core, the problem kicks off when a government is spending way more money than it's bringing in. This could be because of massive war debts, a total collapse in taxes, you name it. But the end result is a giant hole between what they spend and what they earn. They have to pay the bills somehow, right? And the decision they make right here, well, it can set them on an incredibly dangerous path.
You know, what's so fascinating about this is the psychology. From the outside, just printing money seems crazy. But when you're in the middle of a crisis, it can actually feel like the only sensible option. It's a way to avoid an immediate, painful economic crash. It's a short-term fix that, as we're about to see, creates a long-term problem that is just devastating.
And this is a perfect example of the trap they get into. Think about post-World War I Germany. Inflation was so out of control that the existing money couldn't buy anything. I mean, by late 1923, all the money from 1913 would get you a single loaf of bread. So if they had stopped the printing presses, there literally wouldn't have been enough physical cash for people to buy and sell stuff. They were forced to keep printing just to keep the lights on.
Okay, so this is where a really bad problem escalates and turns into a full-blown, self-feeding spiral of doom.
This chart just captures that moment perfectly. It's the crossroads. The blue line shows the typical recovery from a depression. Yeah, it's painful, but it's manageable and things eventually get back to normal. But that red line, that's hyperinflation. That is a complete, total free fall where the currency's value goes to zero. So what's the trigger? What pushes a country off that blue path and onto the red one?
It all comes down to this vicious feedback loop. Step 1, the government prints money. Step 2, all that new money flooding the system means each dollar, or peso, or mark is worth less. Step 3, people see this happening. They lose faith, and they start acting differently to protect themselves. And that leads to step 4. All those behavior changes create new problems that put even more pressure on the government to, you guessed it, print more money. Each step just slams right into the next.
And this right here is the real turning point. This is when the problem jumps from the government spreadsheets and gets inside the head of every single person in the country. People just stop trusting their own money. They start making moves to protect themselves, but the tragic irony is that by doing so, they collectively make the whole situation so much worse.
So what does this look like in the real world? Well, first, you get this wage cost spiral. Prices go up, so workers demand bigger paychecks just to survive. But then, businesses have to raise their prices to cover those higher wages. It just goes round and round. At the same time, anyone with any savings starts what's called a capital flight. They are frantically trying to sell their local money for anything else. US dollars, gold, whatever feels safe. And then, the credit system just freezes up. Nobody's going to lend you money for more than a few days because they know it'll be worthless by the time you pay it back.
And this death spiral of behavior and psychology, it all leads to one final destination: the complete and utter failure of the currency itself.
You know, we never think about it, but money has 3 basic jobs. 1, it's supposed to store value for the future. Well, hyperinflation completely obliterates savings. 2, it's a unit of account, a yardstick for prices. But how can you price a cup of coffee when it costs $1 billion? And finally, it's a medium of exchange. That breaks down completely when sellers just start refusing to accept the worthless paper, demanding foreign money, or even just bartering for goods instead.
I mean, just to understand how desperate things get, look at this. People in Weimar Germany weren't buying factories to make stuff. They were just buying physical things, machinery, buildings, even, and I'm not kidding, rocks. Because a literal rock in your backyard was a safer place to park your wealth than the national currency. It's just insane.
And almost inevitably, when the economy breaks down, society is not far behind. When money fails, commerce just stops. People can't get the things they need. Police, firefighters, they stop showing up to work because their pay is worthless. As the source material grimly puts it, this is when society itself really starts to come apart at the seams.
Okay, so once you're trapped in this absolute nightmare, how does it ever end? And for us, what are the big takeaways for anyone thinking about investing?
This slide lays it out pretty clearly. The winners are the people who own real, tangible stuff: gold, commodities, or stable foreign money like US dollars. The losers, well, obviously anyone holding the domestic currency, but also anyone holding bonds. A bond is just a promise to be paid back in that same, now worthless currency. And what's really interesting is that even stocks, which you'd think represent real businesses,
eventually become a losing bet as the entire economy just grinds to a halt. The only way to stop this spiral is to just hit the reset button, a hard reset. The government has to create a brand new currency, one that's backed by something credible and real, like gold or a big pile of foreign money. They have to rebuild trust from absolute scratch, because the old currency is now nothing more than a historical relic.
And all of this brings us to one final, really big thought. A hyperinflation spiral is a powerful, frankly terrifying reminder that money isn't just paper or numbers on a computer screen. It's a shared belief. It's a story we all agree to believe in. And it only works for as long as we all keep telling ourselves that story. Which leaves us with a pretty big question, doesn't it? How strong is that story, really?
You know, when we think about war, our minds usually go to battles, borders, and politics. But what if the biggest changes aren't happening on the battlefield at all? What if they're happening in the banks, the factories, and the stock markets? War doesn't just reshape maps, it completely rewrites the rules of a country's entire economy. Let's dig into how that works. So that's the big question for today, right? What really happens when an economy goes to war? We're going to break down the whole life cycle from the tensions that start it all to the often devastating aftermath by looking at what the historical data actually shows us. Okay, first things first, let's get a clear definition. A war economy isn't just, business as usual during a conflict. Nope, it's a total transformation. The normal rules of supply and demand, they get thrown right out the window. The entire economic engine of a country gets rewired for one single purpose: winning the war. So how does a country even get on this path? Well, it's rarely an accident. When you look back through history, you see this dangerous recipe that shows up again and again, leading nations straight toward conflict. The data points to this kind of two-part formula. It usually starts at home, with deep economic divides, big gaps between the rich and poor. That kind of internal conflict often fuels the rise of aggressive, nationalistic leaders. And then, when you combine that with growing tension between powerful countries, the odds of a war just skyrocket. You can really see the fork in the road here. Nations can go down a win-win path, tough negotiations, sure, but respectful. Or they can slide into this lose-lose scenario of mutual threats and aggression. And here's the scary part. It takes two sides to cooperate, but it only takes one side to force everyone down the path to conflict. And once that path is chosen, man, the transformation is just immediate and total. A country's entire economy gets remade almost overnight to feed this all-consuming war machine. And you can see just how dramatic this shift is right here. The moment a country enters a war, government spending, that blue line, just shoots for the moon, completely taking over. At the exact same time, private sector spending, the red line, plummets. The government essentially becomes the economy, pointing every last dollar toward the war. And this isn't just about money, it's about people. You can see the number of military personnel just explodes as a percentage of the population. And that, in turn, drives this massive spike in military spending. The two are locked together. More soldiers need more money, more tanks, more of, everything. I mean, just to put this in perspective, during World War II, a staggering 20% of the entire U.S. workforce moved into the military. Think about that. That's 1 out of every 5 working people. It's an economic shift on a scale that's almost impossible to imagine. But how do you pay for all this? You certainly can't fund it from taxes alone. It's just not possible. A modern war demands massive, massive borrowing. It means draining your national savings and, critically, having good enough credit that other countries will actually lend you money. A nation's financial health is put to the ultimate test. So, the fighting eventually stops. What happens next? Well, this is where the story splits into two very, very different paths. A reckoning comes for everyone, for sure, but it is not an equal one. Now, to be clear, after a big war, nobody comes out completely fine. Both the winners and the losers are saddled with enormous debts and a painful recession. But for the countries that lose, wow, the economic devastation is on a whole other level. I mean, this data tells a pretty grim story. The winners' economies take a hit, for sure, but the losers' economies absolutely crater into a deep, painful depression. And at the same time, look at inflation. It goes up for everyone, But for the losers, it spirals into hyperinflation because they're forced to just print money to try and stay afloat. And here's exactly why that happens. You can see all countries run these huge wartime deficits. But the losers are backed into a corner. Their credit is destroyed, so they only have one move left: print money. That green line you see shooting for the moon, that's their money supply, just exploding, and it completely destroys the value of their currency. And the final bill comes due right here, in their national savings. The winners, in red, are eventually able to start slowly rebuilding what they spent. But the losers, that green line, they watch their national wealth get completely wiped out, just gone. It leaves them financially broken, sometimes for generations. So after going through all this data, looking at all these cycles of boom, bust, and war throughout history, the analysis boils down to one single, ironclad rule for any national leader. What's coming up is a really stark warning, one that was basically forged in the economic wreckage of history's greatest conflicts. The worst thing a country could ever do is get into a lot of debt and lose a war, because there is nothing more devastating. Above all else, don't do that. It's a simple message, really. It is, without a doubt, the single most destructive economic event a nation can ever go through. And that kind of leaves us with one final thought to chew on. When you look at the world today, the economic powerhouses, the currencies we all use, the global order itself, so much of it was forged in the aftermath of these very cycles. So how has this historic pattern shaped the very world we're all living in right now?
National debt. You hear those numbers on the news, we're talking trillions of dollars, and it just sounds terrifying, doesn't it? Like some kind of catastrophe just waiting to happen. But what if the story we're all told about these massive debt crises is missing the most important part? Okay, let's get into it.
So is it this ticking time bomb we're all worried about? Are we just counting down to some big economic explosion? I mean, the anxiety is real. But what if the real danger isn't the debt itself? What if it's something else entirely? The source material for this explainer suggests we might be looking for danger in all the wrong places.
Because the real trigger, the thing that actually sparks the catastrophe, it isn't necessarily the debt. No, it's something much more human and a whole lot more unpredictable.
And boom, there it is. This is really the heart of the matter. It's not about the numbers on a spreadsheet. It's about the decisions people make when they're under incredible pressure. The real risk, it turns out, is human error.
So let's try and step into their shoes for a second. Imagine you're in charge when a crisis hits. It is an absolutely insane balancing act, and the fate of millions of people is hanging in the balance.
So how do you even begin to manage a debt crisis? Well, on paper, the strategy sounds simple enough. You just spread out the pain. Avoid one massive, devastating shock by chopping up the hit and distributing it over years and across different groups. But actually doing that, oh man, it's like trying to land a jumbo jet in a hurricane. It's much more of an art than a science, and it's incredibly difficult.
And a huge factor in whether that jet can land safely comes down to one critical thing. What kind of debt is it? If the debt is in your own currency, well, you've got more tools in your toolbox. You can, for example, print more money to help manage the payments. But if you owe that money in a foreign currency, like US dollars, whoa, now your hands are basically tied. It's like you're in a fight with one arm behind your back. The choices become agonizing, and the consequences are almost always way, way worse.
So why do policymakers sometimes fail so spectacularly? Well, it's rarely just one thing. It's a perfect storm. I mean, look at this list. Sometimes they genuinely don't know the best way forward, or maybe they just lack the legal power to act. A lot of the time, the country's own political system, which is built for slow, careful decisions, just seizes up right when you need to act fast. Then you add intense public pressure, constant criticism from every side, and a hurricane of misinformation, and suddenly making the quote-unquote right choice becomes politically impossible.
So you've got this impossible situation for leaders, this political nightmare, and when you're in the middle of it, it absolutely feels like the end of the world. But what if I told you that from a different angle, all that chaos is just a blip? Okay, let's pull the camera way, way back and look at the bigger picture.
So here's the crucial point. While crises feel like they're everything, over the grand sweep of history, they really are just bumps in the road. The real engine of a country's wealth, the thing that truly matters, is its long-term ability to innovate and produce, its productivity.
Take a look at this. On the left, you've got the economic history of the USA. On the right, Great Britain. Those sheeted areas, those are the huge, scary crises, the Great Depression, World Wars, major recessions. They look like sharp drops, don't they? But now just zoom out with your eyes. Look at that overall trend line. That powerful, climbing line is productivity. Over time, it just keeps winning.
And it's not just an American or British thing. Here's the same pattern for Germany and Japan. I mean, think about what these countries went through. Devastating wars, financial collapses that tore them apart. And yet the long-term trajectory is still up. Economies are just incredibly resilient. They seem to have this deep, powerful tendency to recover and grow.
And this isn't just a story about the West either. Here are China and India. You see the exact same thing. Those crises, those shaded bumps, they're just dwarfed by the incredible force of that long-term growth. From a purely economic perspective, it really does seem like time heals these wounds.
So, if the economies eventually recover, what's the big deal? Where's the real, lasting damage from all this? Well, it's not in our wallets, it's in our politics.
And this, right here, is the punchline of this whole explainer. The economic damage might be temporary, but the political fallout, that can change a country forever. The anger, the blame, the search for simple answers during a really complex time, that can lead to huge political shifts, like a big rise in populism.
So, how does an economic crisis morph into a political one? Well, this slide lays it out pretty clearly. First, the crisis hits, and real people feel real pain. Then, the leaders have to make these tough, really unpopular choices to fix it. Things like austerity, which means deep cuts to government spending, or controversial bailouts for banks. That, of course, creates a massive political backlash. The whole atmosphere becomes toxic, just full of finger-pointing and misinformation. And the end result? A permanent change to the political landscape.
Which brings us right back to where we started. All those flashing headlines about trillion-dollar debts are focused on the temporary economic storm, but they're missing the bigger, more permanent story, the political scars that these storms leave behind.
And that's really the thought I want to leave you with. We've seen from the data that economies have this remarkable ability to bounce back over the long run. The truly unsettling question is whether our political systems, once they've been fractured by crisis and anger, can ever really do the same.
Today, we're going to dive into one of the most terrifying economic stories in all of history, the German hyperinflation of the 1920s. It is an absolutely wild cautionary tale about how an entire country's money can lose all meaning, and in doing so, set the stage for a total political catastrophe.
I mean, think about it. How does that even happen? How does the money in everyone's pockets, in their bank accounts, just become worthless paper? Well, it happened. And the story of how is just a chilling lesson in economics, politics, and, human psychology. Let's unpack it.
So if you want to cook up a currency collapse, you need the right ingredients. It's kind of like a recipe for disaster. First up, you need a currency that isn't a global reserve, like the US dollar is today. Then you add a huge, and I mean huge, pile of debt that you owe in foreign currencies. Then you mix in massive government budget deficits year after year. Sprinkle in some interest rates that are way lower than inflation, and top it all off with a public that's already kind of nervous about their money losing its value.
And by the time World War I was over, Germany didn't just have one or two of these ingredients. No, they had every single one. What happened next wasn't just some run-of-the-mill economic crisis. It was one of the most iconic, catastrophic inflationary depressions in modern history. This is that story. Okay, so our story really kicks off with World War I. You see, Germany went into that war thinking it was going to be short, decisive, over in a few months. Instead, they got bogged down in a long, brutal, and incredibly expensive war that somebody had to pay for.
Now, back then, most big countries were on what was called the gold standard. Basically, paper money was just a claim check for a certain amount of gold in a vault. But when you need to fund a massive war, that system is like a straitjacket. It limits how much you can spend. So in July 1914, just weeks after the war began, Germany did something huge. They suspended the gold standard. This let the central bank print money to pay for the war, and that one decision had absolutely monumental consequences.
With this newfound freedom, they just borrowed, and then borrowed some more. The government ran these enormous budget deficits averaging around 40% of the entire economy. By 1918, the total government debt hit over 100 billion marks. That's 130% of the country's whole economic output for a year. It's an insane amount of debt.
Now, at first, the German people were really patriotic, and they bought up government war bonds to help the cause. But as the war just dragged on and on, inflation started to creep up. By 1915, it was already over 30%. And with war bonds paying a fixed 5% interest, well, people quickly realized they were losing a massive amount of money. It was a guaranteed way to lose purchasing power. So pretty soon, the public's appetite for that debt just vanished.
So if the public won't buy the government's debt, who will? Well, the central bank. The Rijksbank had no choice but to step in and basically print money to cover the government's bills. And you can see what happened. The number of marks in circulation just exploded, and the mark's value against the dollar started to slide. This created this horrible, vicious cycle. Printing money caused inflation, which made people even less willing to lend the government money, which forced the central bank to print even more money. And so it began.
So Germany stumbles out of the war with these huge domestic debts and rising inflation. That's a serious crisis for sure. But what came next, with the peace treaty, would turn that crisis into an outright unbelievable catastrophe.
The Treaty of Versailles was just a total shock to the system. I mean, look at this. Germany lost huge chunks of its industrial capacity, the very engines of its economy. We're talking almost half its pig iron capacity, over a third of its steel. And on top of that, it was hit with an interim reparations bill of 20 billion gold marks. This wasn't just punitive, it was designed to be crippling.
And believe it or not, that was just the opening act. In May 1921, the final bill came due in what was called the London Ultimatum. The total amount? A staggering 132 billion gold marks. To give you some perspective, that was about 330% of Germany's entire annual economic output. It's like asking someone to pay a bill that's more than 3 times their yearly salary. It was impossible.
And here is the absolute killer detail. The war debt, the domestic debt, was in regular paper marks, so the government could and did just print more marks to make that debt worth less. But the reparations, oh no, that debt was in gold marks, which was basically a foreign currency. You can't print gold. This bill had to be paid with real stuff, real economic value, which Germany just did not have.
This put German leaders in a totally impossible trap. What were their options? Cut government spending? Not a chance. There was widespread poverty and a real threat of a Bolshevik-style revolution. You had to keep social services going. Okay, what about raising taxes? Well, they were already sky high, and raising them more would just cause wealthy people to pack up their money and leave the country. Borrow from other countries? Are you kidding? No one would lend to a bankrupt nation. And they couldn't just default, because the Allies made it very clear they would occupy the Ruhr Valley, Germany's industrial heart, if they missed a payment. They were completely boxed in.
So with really only one option left, printing more money, the German economy did something really weird. Between 1920 and 1921, it looked like it was staging a miraculous recovery. But this rebound, well, it was built on a foundation of sand. So you've got this wild situation where the US and the UK, the winners of the war, are tightening up their money supply, causing a global recession, but Germany is doing the exact opposite. They kept interest rates low and the printing presses humming. And for a minute, it seemed to be working. Unemployment fell, exports were booming, and factories were buzzing.
The logic seemed pretty simple. A weak mark made German goods incredibly cheap for other countries to buy, so their exports just took off. And unemployment, which had spiked right after the war, started coming way down. On the surface, it really did look like a success story.
But this whole recovery was a total mirage. It was fueled by what the famous economist John Maynard Keynes called the greatest speculative bubble ever known. See, foreign investors, they looked at Germany and thought, well, it's a great country, it's going to recover eventually, and when it does, the mark will go up and we'll make a fortune. So they poured all this hot money into the country, which propped up the currency and helped pay the government's bills, but it made the entire economy incredibly fragile, like a house of cards.
And every bubble eventually has to pop. The London Ultimatum, that impossible reparations bill, that was the pin. Foreign speculators panicked, that hot money fled the country in an instant, and Germany was thrown to the final, catastrophic inflation spiral.
The market's reaction wasn't just fast. It was absolutely brutal. The moment that final reparations number was announced, the mark just collapsed. It fell 75% by the end of the year. Inflation, which had kind of stabilized for a bit, came roaring back. The world finally understood Germany could never, ever pay this debt, and trust in the currency just evaporated overnight.
And what followed was the classic death spiral of hyperinflation. Let's walk through it. First, that impossible foreign debt causes what's known as capital flight. Investors are yanking their money out of the country as fast as they can. That weakens the mark. A weak mark means the price of everything you import skyrockets, which drives up inflation for everyone. So what does the central bank do? It prints even more money to keep the economy from totally seizing up. But that just confirms everyone's worst fears, which leads to even more capital flight, and the cycle just repeats faster and faster and faster.
On the ground, this created this incredible psychological shift called the flight into real assets. People were desperately trying to trade their cash for anything tangible, anything real. They knew their money was losing value by the hour, by the minute, so the second they got paid, they would run out and buy anything at all. As one newspaper put it, it was a monstrous lust for goods.
And this created such a bizarre paradox. Shop shelves were constantly empty. Car sales were hitting all-time highs. Factories were running 24/7 at full capacity. If you just looked at the numbers, the economy looked like it was booming, but it wasn't prosperity, it was pure, unadulterated panic. It was the frantic activity of an entire society trying to get rid of a worthless currency before it literally evaporated in their hands.
And that really leaves us with this final, haunting question. The German story shows us that money, at the end of the day, is a social contract. It's built on trust. It's just a shared agreement that the paper in our pocket today will be worth something tomorrow. But what happens when that trust completely breaks? The German hyperinflation isn't just a story about economics. It's a story about the incredibly fragile line between order and chaos.
Welcome to The Explainer. Today, we're going to break down the script behind one of the most devastating financial crises in history, the Great Crash of 1929, and the absolute monster of a depression that it kicked off.
So let's start with a question that kind of challenges the story we all think we know. We tend to imagine the 29 crash as this total bolt from the blue, right? A catastrophe that nobody could have possibly seen coming. But what if that's not the whole story? What if it wasn't random at all?
Well, the source material we're looking at today makes a really fascinating argument. It says that what happened wasn't a freak accident. Instead, it was a textbook example of what it calls an archetypal big debt cycle. And the wild part is, this is a pattern that has repeated itself over and over again, including in the 2008 financial crisis.
All right, so let's get into it. Act 1 of this whole drama, the creation of a massive credit-fueled bubble during the Roaring '20s.
You have to remember, after World War I, the U.S. economy was on fire, and it was all being driven by these amazing new technologies. I mean, just look at the numbers here. Radio sets, they went from 60,000 to over 7 million in just 6 years. Car registrations almost tripled. This wasn't just steady growth, it was an absolute revolution. And it created a ton of wealth and this incredible feeling of optimism. So here's the thing. It turns out that most of these huge financial bubbles, they pretty much follow the same playbook. They share these 7 key characteristics you see here. And you better believe it, the 1920s checked every single one of these boxes. From widespread optimism and tons of debt, to a flood of brand new, totally inexperienced buyers jumping into the market. And here you can see that leverage, that borrowed money in action. On the right, you've got the Dow Jones just soaring. But look at the chart on the left. The debt used to buy those very stocks, margin debt, is climbing right alongside it. It actually tripled in just 3 years. This wasn't just investing. It was a massive nationwide bet, and it was all made with borrowed cash. And make no mistake, this wasn't just some Wall Street thing. This quote here really captures the mood, right? Everyone was talking about it, from barbershops to factories. Brand new buyers from every walk of life were flooding into the market, totally convinced that stocks were a one-way ticket to getting rich. So what was fueling all this? Well, you had these new financial gadgets like something called call loans. You can think of them as a kind of shadow banking. They made it incredibly easy to borrow money to buy stocks. But, and this is a huge but, the lender could demand their money back at any time. Talk about a hidden risk just waiting to blow up the entire system. And it wasn't just call loans. You also had these investment trusts. They were basically the mutual funds of their day, and their popularity just exploded. I mean, just look at this chart. The number of new trusts founded each year literally goes vertical in 28 and 29, pulling even more money into a market that was already red hot. You can just imagine the feeling in the air, right? It was pure euphoria. Experts were out there saying America had entered a new era of permanent prosperity. This quote from an Ohio State professor in 1929 is just perfect. It perfectly captures that dangerous, this time is different thinking that always pops up at the peak of every bubble. Okay, so we've set the stage. The bubble is massive. Now for Act 2, how it all came crashing down. So what was the pin that finally popped this bubble? It was the Federal Reserve. They started tightening their policy. You can see it right there on the left. Short-term interest rates start climbing and climbing fast. All of a sudden, that cheap, easy debt wasn't so cheap anymore, and the whole house of cards started to wobble. And there it is, the absolute peak. September 3rd, 1929. And to really put this into perspective for you, the Dow would not get back to this level for another 25 years. A whole generation. The cracks were already forming deep beneath the surface. But here's what's just wild. Even as the ground was crumbling beneath their feet, you had prominent experts telling everyone not to worry. The famous economist Irving Fisher made this statement just 9 days before the first wave of panic selling slammed the market. And when it happened, it was just this dramatic day-by-day collapse. It kicked off with panic selling on Black Thursday, which was briefly stopped by some big bankers who tried to plug the dam. But it was no use. The following week was a complete catastrophe. Black Monday and Black Tuesday. 2 days of insane losses driven by margin calls that just overwhelmed everything. And this headline right here, from the day after that first shockwave, it just perfectly captures that moment of false hope. Leaders were projecting confidence, saying things were sound, but that intervention, it was just a Band-Aid on a gaping wound. The underlying panic and all that debt were just too much to contain. Yep, just 5 days later, the headlines told a totally different story. The bankers' plan had failed, and the full scale of the collapse was impossible to deny. The optimism was just gone, replaced by the cold, hard reality of the crash. Now, here's a really important point. A stock market crash, even a huge one, doesn't have to lead to a decade-long depression. So what happened? How did one spiral into the other? Well, first up, you had this really dangerous period of false hope. The market actually staged a huge bear market rally in early 1930. And get this, it recovered nearly half of what it lost. It was just enough to fool a lot of investors and policymakers into thinking the worst was over. But here's the catch. That optimism on Wall Street was completely disconnected from what was really happening on Main Street. While stocks were bouncing back, these charts show the real economy. Stuff like department store sales and industrial production was already tanking. That disconnect was a massive, blinking red light. And then came a huge policy mistake. The Smoot-Hawley Act raised tariffs on imports like crazy. The idea was, hey, let's protect American jobs. But what it actually did was kick off a global trade war that just slammed the brakes on the entire world economy, which was already on shaky ground. So now the economy is getting worse and worse, and that pain starts to spread to the banks. People are losing their jobs, they can't pay their loans, and they start losing faith, pulling their money out. And that kicked off this horrible wave of bank runs and failures that just sucked all the credit, all the lifeblood out of the economy. And this brings us to the key takeaway, the whole point of this explainer. Look at this. The playbook for 1929 is eerily similar to 2008. Both times you have easy credit, a massive speculative bubble, and these complicated shadow banking systems that nobody really understands until it's way too late. The script is just remarkably consistent. So what's the big takeaway here? It's that by understanding this pattern from 1929, we're not just looking at dusty old history books, we're actually learning how to spot the warning signs for today. Which leaves us with one final big question to think about. If the script for these crises is really this clear, what signs should we all be watching for right now? Welcome to The Explainer. Today, we're digging into the hidden story of the 2008 financial crisis, a crash that brought the entire global economy to its knees. So how did it all start? Let's get into it. You know, back in the mid-2000s, this wasn't just some fantasy question. For millions of Americans, it really felt like a sure thing. The idea that your house was this magic ATM machine was pretty much gospel. And that's the big question, right? To really get how it all came crashing down, we have to rewind to a time when, at least on the surface, the U.S. economy looked absolutely unstoppable. So let's set the scene. Between 2004 and 2006, a lot of people were calling the U.S. economy the Goldilocks economy. You know, it wasn't too hot, wasn't too cold, it was just right. I mean, the economy was just humming along, growing at a really healthy 3 to 4% every single year. Businesses were thriving, people felt confident, and there was this sense that prosperity was here to stay. And jobs? Oh, yeah, jobs were everywhere. The unemployment rate was super low, well below the long-term average. If you wanted a job, you could probably find one pretty easily. But, and this is a huge but, hiding just under all this calm was the gasoline for the fire. See, after a small recession in 2001, the Federal Reserve cut interest rates to the bone, all the way down to just 1%. Money had never been this cheap to borrow. So, with all this cheap money flooding the system, where did it all go? Well, it poured right into the one asset everybody, and I mean everybody, thought was rock solid, the American home. Okay, so this is where the story really takes a turn, because the housing market quickly became ground zero for this massive ticking time bomb. Just look at this. From 2000 to 2006, home prices didn't just climb, they went completely vertical, soaring over 80%. This wasn't normal, healthy growth. This was a rocket ship powered by pure speculation. And you know, this was a bubble in every sense of the word. I mean, it checked all the boxes. You had people borrowing insane amounts of money, a flood of brand new, totally inexperienced buyers jumping in, not because they needed a house, but because they thought it was a foolproof way to get rich fast. And all that debt, it was the rocket fuel. As prices kept shooting up, people just weren't scared to borrow more and more and more to get a piece of the action. It got so crazy that household debt jumped from 85% of income all the way to 120%. Absolutely unheard of. So to keep this whole party going, the banks basically threw the rule book out the window. All of a sudden, you had these things called subprime loans, mortgages with these really low teaser rates. Some banks didn't even ask you to prove you had an income. It was a total free-for-all. The floodgates were wide open. Now, this is so important to understand. This wasn't just about a bunch of homeowners getting bad loans. No, this was about a whole new, incredibly complex financial machine that took all that risk and, well, it basically sprayed it everywhere. That machine was called securitization. And here's the best way to think about it. A bank makes, say, 1,000 really risky loans. Then they throw them all into a blender, creating this big financial smoothie. Then they pour that smoothie into glasses and sell them to investors all over the world. The catch? Nobody knew exactly what toxic stuff was mixed inside. The banks got their money right away and passed all the risk on to somebody else. They had zero skin in the game. And the scale of this was just mind-boggling. This market for financial smoothies, it blew up from under $1 trillion in 2002 to more than $2 trillion by 2006. All that hidden risk was now secretly woven into the DNA of the entire global financial system. All right, so now we get to 2007, and that perfect unstoppable machine, yeah, it was starting to sputter. Let's look at how the first cracks began to show. But if you were just looking at the headlines, you'd think everything was great. The stock market was still on a tear, hitting new all-time highs. The party, it seemed, was still in full swing. And you know what? That's what everyone in charge was saying too. The Federal Reserve Chairman himself, Ben Bernanke, went out and said, "Don't worry, any problems in the subprime market are contained." Wow, that statement would go down as one of the biggest miscalculations in modern economic history. But behind the scenes, the dominoes were starting to fall. First, a huge subprime lender went bankrupt. Then, and this was a big one, 2 giant hedge funds at the investment bank Bear Stearns that were loaded up with this mortgage stuff, they just completely imploded. And this is what finally lit the fuse. Remember those super low interest rates? Well, the Fed had started raising them to cool things down. All of a sudden, those little teaser rates on all those risky mortgages started to jump up a lot. People's payments skyrocketed, they couldn't pay, and for the first time in years, home prices stopped rising and started to fall. The whole house of cards began to shake. And then came the summer of 2007. And those little cracks, they weren't cracks anymore. They were canyons splitting wide open for the whole world to see. This is the moment the contagion officially jumped the ocean. A massive French bank, BNP Paribas, slammed the brakes and froze billions of dollars in funds. Why? Because they admitted they had no idea what their American mortgage investments were actually worth. The poison had spread. This, right here, this is what pure, unfiltered financial panic looks like on a chart. The TED spread is basically a fear gauge. It shows how scared banks are to lend to each other. And as you can see, it just went vertical. Trust evaporated overnight. The plumbing of the entire global financial system just seized up. And just like that, the question wasn't, will my house make me rich anymore? It was something much, much scarier. Is this it? Is the whole system about to come crashing down? All right, let's dive in. Today we're going to tackle something that can feel, well, super complicated, the language of big economic debt crises. You ever turn on the financial news and just feel lost? Like everyone's speaking a totally different language? Yeah, you are definitely not alone. I mean, they throw these terms at you, right? Deleveraging, balance of payments, and it's so easy for your eyes to just glaze over. It feels like you need a PhD just to follow along. But here's the thing. Those aren't just random scary words. They're actually the vocabulary of a story that repeats itself over and over again, the story of a big debt crisis. So let's learn the language, not as a boring list, but as a real narrative. So where does our story begin? Well, like a lot of dramas, it starts when everything seems great. This is Act 1, the boom and the bubble. Let's see how this whole thing gets started. The main character of this first act, it's called a bubble. And the most important word to remember here is unsustainable. Just picture a family that takes out a bunch of loans to live this amazing, super expensive lifestyle. It's awesome for a little while, but you know it can't last forever. That, right there, is a bubble. So what's pumping air into this bubble? A lot of the time, it's something called capital inflows. Basically, it's a flood of money from other countries. Foreign investors get excited, they see a hot market, and they start pouring money in, buying up stocks and bonds. And that cash, it really gets the party going. And with all this money flying around, the economy looks fantastic on paper. You see this huge jump in what's called nominal growth. But nominal is a tricky word. It includes inflation. So prices are going up, which makes it look like the economy is growing like crazy, even if the country isn't actually making that much more stuff. And this is where the danger is lurking. In the boom phase, debt just shoots through the roof. It grows way, way faster than the real economy. Basically, the whole party is being funded by credit cards. And we all know how that ends, right? A nasty hangover. And that brings us to Act 2, because the music always stops. This is the big, dramatic moment of our story, when the bubble bursts. You know, if there's one unbreakable rule in all of this, it's this. These kinds of booms, the ones built on a mountain of debt that just can't be sustained, they always bust. No exceptions. And one of the first big red flags that things are going wrong is what's called a balance of payments crisis. Remember all that money that was flooding into the country? Well, now it's rushing to get out. And the country basically runs out of the foreign cash it needs to pay its international bills. Let's go back to that household idea. It works perfectly here. Usually, you want your income, your inflow, to be bigger than your expenses, your outflow. But in a crisis, suddenly your outflows are way bigger than your inflows, and you've got no more credit. That's exactly what's happening to the entire country. And what comes next often isn't just a little slowdown. We're talking about a full-blown depression. And this is where it gets really, really painful. It's a vicious cycle. Asset prices fall, so people panic and sell, which makes prices fall even more. The whole economy can just seize up. But here's the crucial part, the thing that really defines a depression. It's when the people who are supposed to fix this mess, the central banks, show up on the scene, open their big toolbox, and realize their main tools just aren't working anymore. So that leads us to our final act, the cleanup. What happens now? Let's take a look inside that toolbox and see what the economic first responders can actually do to try and fix things. When a crisis like this hits, the people in charge basically have a playbook, and it really comes down to three main strategies: easing, tightening, and this really long, tough process called deleveraging. Okay, so easing and tightening are pretty much opposites. Think of easing as stepping on the gas. Central banks cut interest rates, they make money cheaper to borrow, trying to get the economic engine started again. Tightening is the brake pedal. They raise rates to cool things off and slow everything down. But honestly, the most critical part of this whole cleanup is deleveraging. You just can't skip this step. It's the slow, often painful job of getting rid of all that debt that was piled up during the party. This is the long, hard road back to health. Now, to manage all of this, there's one number that policymakers are totally obsessed with:
real interest rates. This isn't the number you see on a bank ad. It's the interest rate after you account for inflation. It tells you what borrowing money really costs.
So what happens if that real rate goes negative? Well, it means inflation is actually higher than the interest rate. So if you're saving money, you're literally losing purchasing power. But if you're a borrower, you're paying back less than you borrowed in terms of real value. It's a pretty wild and controversial way to try and get people to spend money.
Okay, so we've covered the boom, the bust, and the cleanup. We've learned the language, so why should you care? Because once you know these words, you start to see a pattern, a really powerful pattern that has repeated itself throughout history.
I mean, the source for this whole explainer wasn't just some casual look back. It was a deep dive into 48 major debt crises. 48! This isn't some freak accident that happens once in a blue moon. This is a recurring feature of our economic system.
So think about it. Capital inflows, lighting up a bubble, which leads to a balance of payments crisis and a huge bust, followed by those tough choices between easing, tightening, and deleveraging. See? These aren't just words in a textbook. They're the literal chapters of a story that we've seen play out over and over and over again. At the end of the day, learning this language is like getting a map. It gives you a way to understand what's happening in the world economy. And that leaves us with one big question for you. Now that you know the language, do you think you can spot the signs?
Let's talk about the Great Depression. But we're not going to look at it as some kind of one-off black swan event. We're going to explore it as something different, a predictable pattern, a cycle of boom and bust that we've seen again and again throughout history.
So what if a crisis like this wasn't just some random bolt from the blue? What if you could actually see the signs? What if it follows a script? Well, today we're going to reframe the Great Depression as just that, a classic case of a deleveraging cycle. It's a predictable story in 3 acts: the boom, the bust, and the really tough choices that have to be made afterward.
All right, so here's how we're going to break this all down. First, we'll lay out what this predictable cycle actually is. Then we'll walk through each of its 3 phases: the bubble, the ugly depression, and something called the beautiful rooflation. And finally, we'll look at the huge political shockwaves this economic earthquake sent across the world. Okay, so what is this pattern we're talking about? The source material gives it a name: the deflationary deleveraging cycle. I know, it's a mouthful, but it's really just a powerful way of understanding how these huge debt crises unfold. Think of it like a 3-act drama that seems to play out time and time again in history. And this chart right here, this is basically our map for the entire journey. It shows what happened in the United States during this whole period. You can see it so clearly. The peak of the bubble, right around 1929, then the absolute nosedive into the Depression, and finally that long, slow climb back up during the reflation. We are going to follow this exact path, step by step.
So let's break that journey down into its 3 acts. Act 1 is the bubble. This is the party, right? Everything's fueled by easy credit and assets are going to the moon. Act 2, the depression. This is the brutal hangover. The bubble pops and everything starts to unwind in a really painful way. And then you have Act 3, the reflation. This is when the policymakers, the governments, and central banks have to step in and try to clean up the mess. So let's dive into Act 1, the bubble. Now, the interesting thing is, while the crash of '29 was this huge global event, the bubbles that came before it, well, they didn't all look the same. They actually grew in pretty different ways depending on where you were in the world. So on one side, you had countries like the United States, which were in the middle of a classic bubble. You know, think of the Roaring '20s. The economy's booming, the stock market's on fire, everything feels great. But then you have places like the UK and Japan. They weren't really having that same kind of party at home, but they had piled on massive amounts of debt. And that made them just as fragile, just as vulnerable to the global shock when it finally hit. And this chart really drives home that one common ingredient. It didn't matter if it was a classic bubble or a connected one. The result was the same: a giant mountain of debt. I mean, just look at the UK. Debt was at 210% of its entire yearly economic output. The US was at 125%. When you have that much leverage in the system, you are setting the stage for a total disaster. You see, a mountain of debt that high is just fundamentally unstable. It doesn't take much to bring it all down. All it takes is a single pinprick to pop that bubble, and that brings us to Act 2, the ugly depression. The 1929 crash was that pin. And what came next was this synchronized, absolutely devastating collapse across the entire world. This scorecard, it just shows you how brutal this period was. In the US, the economy shrank by more than a quarter. The stock market lost a mind-boggling 84% of its value, and unemployment shot up by 23 percentage points. The pain was everywhere. The UK, France, they also saw these massive contractions. This wasn't just a garden variety recession, it was a complete economic wipeout. And this brings us to one of the most painful, most counterintuitive parts of any depression. It's called the deleveraging paradox. Think about it. Everyone, people, businesses, even governments, is frantically trying to pay down what they owe. But somehow, the overall debt burden, that ratio of debt to income, actually gets worse. It goes up. How on earth is that possible? This slide shows you exactly why. Let's look at the chart on the left for the US. That total bar, that 26%, that's how much the debt to GDP ratio grew every single year. So people were trying to pay down debt, but as you can see from that big negative blue bar, their incomes were falling and prices were collapsing even faster. That's deflation, and it's a killer. It makes every single dollar you borrowed in the past a much heavier weight today. It's literally like trying to run up an escalator that's going down. The UK on the right had the same problem. They were running as fast as they could just to fall further behind. Now, a paradox that painful can't last forever. It forces a response. And that brings us to Act 3, the reflation. The source material calls this phase the beautiful deleveraging. That is, if you get it right. But as we're about to see, the choices that policymakers made here led to wildly different results. So what exactly is a beautiful deleveraging? Well, think of it as a really delicate balancing act. It's when policymakers somehow manage to bring that crushing debt burden down without totally destroying the economy in the process. They have to use a mix of 4 tools: a little bit of belt tightening, some debt write-offs, printing money to create some inflation, and getting the economy growing again. The whole goal is to make incomes rise faster than the debt. And right here was the crucial difference. The US, they went all in. They pulled almost every policy lever they could find. A huge move was breaking from the gold standard, which basically let them print more money and get things moving. The UK, on the other hand, was way more passive, way more restrained in its approach. And wow, this slide just shows you the result of those 2 different philosophies. Look at the US on the left. Their debt burden fell by a massive 21% a year. But look at how they did it. That big blue bar, that's real economic growth, and the light blue one is inflation. They did all the heavy lifting. The US literally grew and inflated its way out of the problem. Now look at the UK on the right. They had to rely on that slow, painful process of actually paying the debt down, which meant a much, much slower recovery from the debt problem. So here's the bottom line. The aggressive policies in the US ignited strong nominal growth. That's just real growth plus inflation. It averaged 8%, which was way higher than interest rates at the time. And that is the magic formula. When your economy is growing faster than your debt is piling up interest, the burden of that debt actually shrinks compared to the size of your economy. That's how you escape the trap. But, these massive economic cycles, they don't happen in a vacuum. The trauma of the Depression and these completely different paths to recovery ended up fundamentally rewriting the political landscape. And that brings us to our final act, the political aftermath. This final scorecard is pretty telling. Now, what's interesting is the UK, despite its passive policy, actually got its economy back to where it was the fastest, in just 5 years, mainly because its initial crash wasn't as deep. The more aggressive US took 7 years. But the real cautionary tale here is France. It took France a staggering 21 years for its economy to get back to where it was before the crash. 21 years. And these economic outcomes had massive political consequences. The crisis brought FDR and the New Deal to power in the United States. In France, that long, painful slump led directly to the rise of the populist leader Léon Blum. And in Japan, the economic chaos was a key factor that helped pave the way for militarists like Hideki Tojo to take control. These events didn't just change economies, they completely redrew the political map of the 20th century. Which, of course, leaves us with one big question. They say history doesn't repeat, but it often rhymes. Today, almost a century later, global debt is once again at historic, eye-watering levels. So when you look at this clear 3-act pattern, you just have to ask yourself, are we just living in the early scenes of the same play all over again? What if I told you there's a predictable playbook for total economic disaster? That's what we're digging into today. We're going to deconstruct one of the most destructive events a country can go through, the debt crisis. All right, here's a question for you. What could post-World War I Germany and, say, 1980s Argentina possibly have in common? I mean, they seem like completely different worlds, right? But if you look just a little closer, their economies were shattered by the exact same destructive pattern.
Well, the answer is they both got caught in this devastating trap. It's called a debt crisis death spiral. And let me tell you, this isn't just a bad recession. No, this is a sequence of events that can completely, totally unravel a nation's economy.
And here's the really crucial point. It's not random. It's not just bad luck. Their experiences show us a clear, predictable pattern, a playbook, really, that has repeated itself throughout history, time and time again. So let's do it. Let's break down that playbook step by step. Okay, so every crisis has a beginning, right? For a national debt crisis, the road to ruin usually starts down one of two very different paths. So on one hand, you've got what's called a post-war shock. Just picture Germany after World War I, right? A massive nation-altering catastrophe forces the government to borrow insane amounts of money just to stay afloat. But then you've got a completely different trigger, the credit-fueled bubble. This is the story of places like Argentina in the 80s, where easy money and a booming stock market made borrowing feel like a total sure thing for everybody. So check this out. Whether it's a devastating war or a wild credit-fueled party, the result is exactly the same. A massive mountain of debt. But here's the really critical detail, the fatal flaw in the plan. A huge chunk of that debt isn't in their own currency. It's owed in a foreign one, like US dollars. Now, you got to remember that detail, because it's basically the poison pill that brings the whole system crashing down. And the scale of this borrowing, it's just breathtaking. To pay for World War I, Germany's debt ballooned to 158% of its entire annual economic output. Think about that. Meanwhile, in those bubble years, Argentina's stock market was pumping out an incredible 52% return per year. Of course, that fueled a borrowing binge. You see it elsewhere, too. Chile's debt hit 145% of GDP. Mexico has hit 65%. The party is absolutely in full swing, but trust me, the bill is coming due. And that, of course, brings us to the next chapter in our playbook, the inevitable and, incredibly painful crash. When the crisis finally hits, it doesn't sneak in. It kicks the door down. And it usually shows up with three classic symptoms that all feed on each other. First, economic output, GDP, it just plummets. Second, financial wealth gets vaporized as stock prices crash. And third, the nation's currency goes into a complete free fall. So first, let's talk about the economy itself. It just collapses. Germany's real GDP plunged into a deep, deep depression after the war. And this wasn't some one-off event. During their crisis back in the 80s, the economies of both Argentina and Chile shrank by a staggering 14%. Just gone. At the very same time, the stock market just becomes a wasteland. German stock prices were essentially wiped out. They fell 97%. Can you even imagine that? An entire generation of wealth just gone. Poof. And the pattern repeats itself. You see it in Latin America. Argentina's market falls 91%. Mexico's falls 86%. Utter devastation. Okay, now here's where things get really, really twisted. You'd think, right, that with the economy in a total depression, the debt problem might actually start to ease up a bit. But nope. What actually happens is the exact opposite. The debt burden gets worse. So how is that even possible? This is the great paradox of a debt crisis. During its depression, Germany's debt, as a percentage of its economy, actually exploded. It rose 31% per year. So how? Well, there are two reasons. First is just simple math, right? The economy is shrinking, so the debt looks way bigger in comparison. But the second reason, this is the real killer. Remember that poison pill? All that debt they owed in a foreign currency? As Germany's own currency became worthless, the sheer number of German marks they needed to scrape together to repay those foreign debts, it went through the roof. It made the burden completely unbearable. So, this all leads policymakers to a terrible, terrible crossroads. And the path they choose next can turn what is already a severe depression into an outright economic catastrophe. So here's the dilemma they're facing. Foreign investors are running for the exits, pulling all their money out of the country. The leaders basically have two choices, and neither of them are good. Option one, impose brutal austerity. We're talking slashing spending, jacking up interest rates. It's incredibly painful for the people, but it can stabilize the currency. Or there's option 2, the one that seems so much easier. Just turn on the printing presses and print more money to pay the bills. And Germany's choice? Well, it's illustrated perfectly right here. You can see the amount of currency in circulation. That's not a line. That is a vertical wall. Faced with impossible debts and a totally collapsing economy, they just turned on the printing presses, and they never looked back. And the result? Well, it's a word we pretty much all associate with 1920s Germany: hyperinflation. As the government printed literally trillions of marks, the currency became worthless. Prices spiraled completely out of control. At its absolute peak, inflation in Germany hit over 10,000%. Just try to wrap your head around that. And just like we've been saying, the playbook repeats. It's almost eerie. You see Germany's hyperinflation spike in 1923, and then you see Argentina's in 1985, where inflation topped 1,000%. I mean, look at these charts. They're 60 years and an ocean apart, but they tell the exact same story. The same choice leads to the same disastrous outcome. So the big question is, how does a country ever escape this death spiral? Well, the final chapter of the playbook is all about the long, and believe me, painful path back to some kind of stability. The technical term for this is deleveraging. It's basically the process of finally bringing that crushing debt-to-income ratio back down to earth. And listen, there is no easy way to do this. It's a brutal, messy mix of policies. You're trying to spark some growth, you're imposing painful spending cuts, you're defaulting on some debts, and yeah, as we've seen, you're letting massive inflation just wipe out the value of all those old debts. So how did Germany finally get out of it? Well, during what's called the reflation period, that debt ratio was finally crushed. But how? Ironically, it was the hyperinflation itself that did most of the dirty work. It just made all the old debt completely worthless. The final move was to abandon the old currency entirely and create a brand new, stable one. It was basically like hitting a hard reset on the entire monetary system. But a reset like that, it comes at an almost unimaginable cost. This isn't just a recession, you have to understand. It is a lost generation of economic progress. Just look at how long it took for these economies to get back to where they started, just back to square one. For Brazil, it was 4 years. For Chile, 5. For Argentina, 7 years of lost time. And for Germany, 15 years. A full decade and a half. That's how long it was before the German economy was producing as much as it had before the whole crisis even began. That single number, it just represents an immense amount of human suffering, lost opportunity, and social upheaval. So there you have it. That's the playbook. From the bubble to the bust, to the hyperinflation, and finally the long, painful recovery. It's a pattern that's now over a century old, which, leaves us with one final and pretty crucial question to think about. As global debt today reaches all-time new highs, is history getting ready to rhyme once again?
All right, today we're diving into a set of economic tools that are, well, they're super powerful, but also a bit controversial. They're called macroprudential policies. Basically, they're what central banks grab when their usual weapon, interest rates, just isn't the right tool for the job. So let's jump in.
So picture this scenario. The housing market is just on fire. Prices are soaring like crazy. But at the very same time, the rest of the economy is kind of sluggish, just limping along. So what's a central bank supposed to do, right? If they raise interest rates to cool down housing, they risk absolutely killing the fragile recovery everywhere else. It's a real pickle.
And this is where a really great analogy comes into play. Think about traditional monetary policy, changing interest rates as a sledgehammer. It's a blunt instrument. It hits the entire economy all at once. But these macroprudential policies, they're more like a surgeon's scalpel. They're designed for these super precise incisions, targeting only the specific area that needs attention.
Okay, so why is that kind of precision so important? Let's dig into why that big ol' sledgehammer just isn't always the right tool for the job.
So what exactly are these policies we're talking about? Well, at their very core, they're basically a set of regulations designed to direct the flow of credit. So instead of making money cheaper or more expensive for everyone, they can do things like, say, make it harder to get a mortgage, while at the same time making it easier for a small business to get a loan. And they can do all that without ever touching the main interest rate.
And the classic case for using these tools is exactly what we just described. Think about the years right after a big financial crisis. The central bank is pumping tons of money into the system to get things growing again, right? But all that cheap money starts to fuel these speculative bubbles in things like stocks or real estate, even while the rest of the economy is still struggling. You really need a scalpel to just shave off that froth without hurting the patient underneath.
And the toolkit here is actually surprisingly varied, but most of the policies fall into two main buckets. You've got the ones that target the demand for credit, that's the borrowers, and then you've got the ones that target the supply of credit, that's the lenders.
So on the demand side, it's really all about changing the rules for people who want to borrow money. For example, regulators can crank up the minimum down payment you need to buy a house, or maybe they'll lower the maximum amount you can borrow compared to your income. And a really key tool, which we're definitely going to come back to, is changing the margin requirements. That's the amount of cash you have to put down to buy stocks using credit.
Then, on the other side of the equation, you can target the lenders themselves. You could, for instance, force banks to hold more capital in reserve if they're making what you think are risky loans, which basically makes those loans less profitable for them. You can even use something called supervisory guidance, which, let's be honest, is just a nice way of saying regulators can put pressure on banks to change their lending behavior.
Now, all of this might sound really new and cutting edge, but it's really not. Actually, for most of modern economic history, these kinds of tools were just standard practice. Let's take a look at a few examples.
Okay, take a look at this chart. It shows just how actively the U.S. Federal Reserve used to manage credit in the stock market. See that blue line? That's the margin requirement. You can literally see the Fed raising it over and over again to cool down a hot market, and then lowering it during busts to try and encourage people to invest again. It was like a lever they were constantly pulling and pushing.
And to put a hard number on that, get this. Between 1934 and 1974, the Fed changed those margin requirements 23 times. This wasn't some kind of rare emergency measure. It was a standard go-to tool for managing financial stability.
In this next example really shows how these tools can be used for very, very specific goals. During World War II, the problem was crystal clear. The U.S. needed to shift production away from consumer goods and towards the war effort. So, what was the policy response? President Roosevelt ordered the Fed to restrict credit for stuff like cars and appliances, and the result, which was called Regulation W, actually worked. It cooled down consumer demand, freeing up absolutely critical resources.
So you might be asking, if these tools are so precise, why on earth did they ever fall out of favor? Well, for a few decades, the prevailing wisdom was that markets were just best left alone. But that kind of ignores the huge dilemma policymakers face. Using a scalpel requires immense skill, and it comes with some pretty serious risks.
For starters, you have to correctly identify the problem. I mean, is that a dangerous housing bubble that needs to be lanced, or is it just a hot market that's functioning normally? It is incredibly difficult to know for sure in real time. If you act too soon, you could kill a healthy boom. But if you act too late, well, the bubble pops with disastrous effects.
And second, and this is a really big one, these policies are inherently political. Think about it. When you make it harder for one group to get credit but not another, you are actively picking winners and losers. And that can create some major political backlash from the sectors or consumers who feel like they're being unfairly targeted.
And sometimes, even the most well-intentioned policies create side effects that can linger for years. As one source puts it, some of these policies were allowed to continue for years and had some really distortionary consequences. And a prime example of this was a policy called Regulation Q.
So Regulation Q basically put a cap on the interest rates banks could offer to savers. The goal was noble. It was meant to help small banks compete. But the unintended consequence? As market rates started to rise above that cap, money just fled traditional banks and flowed into these new, less regulated firms, the so-called shadow banks, that could offer a better return. This ended up creating a whole new set of risks completely outside the view of regulators.
And getting the timing wrong, well, it can be absolutely catastrophic. Just look at what happened from 1935 to 36. The Fed, fearing another stock market bubble, tightened up its policy. But the economy was still incredibly fragile after the Great Depression. The tightening was just too much, too soon. By 1938, the country was plunged right back into a severe recession with stocks collapsing by 60%. It's a really stark reminder of the dangers, and experiences like that are exactly why policymakers chose to keep that scalpel locked away for a long, long time.
But despite all those risks, these tools have made a major comeback. These old tools are new again, and today they're seen as a modern essential.
Yeah, that whole period of relying only on interest rates, the 90s and early 2000s, that turned out to be the historical exception, not the new rule. After decades of sitting on the shelf, the precision toolkit is back on the main workbench for policymakers all around the world.
And the reason for their big comeback can be summed up in 1 year, 2008. The global financial crisis was just a brutal, brutal lesson. It proved that managing a single interest rate was totally inadequate for preventing catastrophic financial instability.
So today, countries are actually building formal structures to wield these tools. In the US, there's now a council that exists just to monitor risks and coordinate policy. The UK has a very similar committee within its central bank. The consensus now is pretty clear. To manage a modern economy, you need both the sledgehammer and the scalpel.
So here's the bottom line. We have these powerful, incredibly precise tools that could, in theory, help prevent the next financial crisis. But using them means making very explicit choices about who gets credit and who doesn't, and those are choices with huge economic and political consequences. Which leaves us with the ultimate question. Who exactly do we trust to wield the economic scalpel?